Right now in Australia, over 40% of all properties are being bought by investors. That number alone is enough to trigger massive change. Now in 2026, that change is coming straight from the banks. If you're an investor or even thinking about becoming one, these lending changes will affect your future for sure. Because when investor activity gets too high, you know what, regulator steps in and also the bank tighten the taps. I'm Hitesh Sharma from AtholantWealth, and in this video, I will break down what's really happening, why banks are shifting their policies, and what this means for your ability to build a portfolio in 2026 and beyond. Here is the reality. The last time investor activity crossed this level, it was back in 2014 and 2015. And that's when regulators stepped in and capped how much banks could lend to investors. Now today, affordability has collapsed. 5 years ago, the average buyer could afford about 30% of homes in Australia. And now, that number is just 12%. In Sydney, it is closer to 5%. Now that tells regulator one thing. Investor dominance is pricing everyday Australians out of the market. So yes, the change is inevitable. The big banks are already moving. The trust lending strategies that one investor uses to preserve borrowing capacity, they are being limited and paused or restricted. Now some banks now only allow them for existing clients. Others have stopped them altogether, and that means the strategy many investors relied on to scale portfolios is quietly being dismantled. Now not because it's bad, but because regulators believe risk is building in the system. But here is the part most people are missing. This doesn't mean investing is over. It means the path is changing. Second-tier lenders are not governed the same way. They are not bound by the same restrictions. While their interest rates are slightly higher, many are still cheaper than the last remaining major banks offering this strategy. So what's really happening is this. The big banks are stepping back, but the market is eroding. Investors who understand this shift, they won't stop. They will adapt. Now let's be honest. Paying an extra few thousand a year in interest feels uncomfortable. Yes, it does. But when a well-chosen property can grow by 50k to 100k in a single year, the real risk is doing nothing. The danger is not higher rates. It's sitting out while opportunity compounds. But this only works if you know what you're doing. Blind buying in 2026 is expensive. Overpaying in a mixed market is dangerous. The winners will be the ones who educate themselves, understand where value is moving, rather than chasing the headlines. Also, the lending environment is changing. And that is not to stop investors, but to separate the prepared from the hopeful. So those who understand the system, they will still build. Those who wait for comfort will watch from the sidelines. I'm Hitesh Sharma from AtholantWealth, and in 2026, the market will not reward the optimism. It will reward clarity.